I'd like to talk a little bit more about salary, and I don't want to make it appear as though salary is not important, that you can just put it on the back burner and deal with it later or something like that. And it may look like that whenever I say in year one, there's no salary, and after year one, we start taking a salary. What I'm basically trying to do here is set the company up to be able to pay its expenses, and there's an assumption that you're living off of savings, or you have a job that is supporting you besides what you're doing getting your business up and running. So your business is kind of the side hustle. Salary is extremely important because if you don't factor in salary, it's very much going to skew your finances and give you a distorted result from whenever you're running your financial statements. And I'll show what I mean by that as we go through this. So this information here still applies, but we're going to go into a little bit more detail on the topic of salary. So speaking about salary, there's a few ways you can do this. So in year one, if you're not taking a salary, that doesn't mean you shouldn't account for your salary. What you want to do is figure in a market wage for your salary. So whatever your role is in your company, in your business that you're getting up and running, what would you pay someone to do that? So if you had to hire somebody, not like a VA, but as a full-time employee, how much would you pay them? And likely whatever this role is, I'm betting the salary is going to be probably between $40,000 and $60,000 a year. Although it could be much higher, I'm thinking that's on the lower end of whatever the role is. So in the beginning, you don't have maybe $40,000 or $60,000 to pay on a salary. So as we saw in year one, we're not taking a salary. It still needs to be factored. Here's how. We're going to do something called sweat equity, which is the company is going to owe you X amount of dollars for your salary from the first year that you were not paid. So let's say your salary is $60,000. After year one, the company basically has a debt to you of $60,000. So you need to keep that on the books somewhere so that it's actually something that is owed to you, and it can be built up as equity. Now, what I do suggest after year one and things start settling down, you can start projecting future revenue. You have a very good idea about expenses. Things aren't all over the place like we saw from the previous videos. After year one, I would suggest to start working with an accountant. At least meet with them once, say, here's my structure, here's what I'm doing, and have them set out quarterly taxes, so you'll pay your taxes every quarter. Have them help you with, well, how do I define, where do I put this equity that I've built up in the company by not taking a salary? Just so it's there, it's formalized. When the time comes, when you start making enough revenue, you can begin paying yourself that salary. And you can also, maybe through distributions, begin taking excess of your salary from what you accumulated in equity. Now, distributions are over your salary, and this is getting into more of a corporate structure. And what I mean by that is financially. So maybe a C Corp, an S Corp, or something like that, where distributions matter, even an LLC, although it's more of a legal structure rather than a financial structure. You can still do distributions, but again, if you have an accountant there, they can help you navigate these waters and get it right. So I'm not going to go into detail on that part, but again, I think it's important to have an accountant that you can get this in the beginning set up and have a few of those questions answered so that you're doing things right from the start. And that way it'll make it a lot easier. And it shouldn't really cost a lot to sit down with an accountant for maybe even an hour. It's not going to take them long at all to set you straight, to say, here's where this goes, here's where your equity goes, here's how you can factor that into your books as well. So moving forward, we're going to now look at a simple income statement and see how does salary affect what's going on in your business. So this is an income statement from a business that is a service-based business or one that's purely digital. similar to what I like to call a lightweight company. There's no cost of goods sold, so that's why this line item is zero. Now, if you're buying materials and putting them into a good that is being shipped out or sold through retail, for example, then there's going to be something here in cost of goods sold. Then from here, because there's no cost of goods sold, revenue is dropping down directly to gross profit, and we add in our expenses, or rather subtract them. For marketing, I've kind of bundled all of our expenses, so utilities, rent, hosting, web hosting, whatever it might be, is kind of all into marketing just to keep things simple. That's a $12,000 a year expense, so this is all annual. Then we have our salary. So we talked about the salary earlier, 40 to 60,000. I went ahead with 60 here. And then we have payroll taxes and benefits. So I'm just putting in about $8,100. That's subtracted from our gross profit. We have a net operating income of $94,900. Because there aren't any depreciation or interest expenses in this company, there's no loans, no assets that are depreciating that we're taking depreciation on. So net operating income drops directly down to pre-tax profit. And this is the all-important number that we want to use in a lot of different calculations, pre-tax profit. So here this business is obviously quite higher than what we were looking at in the previous video, so $175,000. This is a full-time business. So this is not one that is being run part-time as a side hustle or anything like that. And salary in this case is extremely important because it is full-time. If you're working in this business, you should be drawing that salary. And then we can see this business grows into year 2, a little bit more revenue, so the salary increases a bit there as well. So if you look at this, in order to get the pre-tax profit, salary is definitely factored in. And you can take now this pre-tax profit number, which is pretty accurate based on what we've done here with salaries and labor, and you can compare it to revenue. So this gives you some ratio of pre-tax profit to revenue. In this case, it may be kind of close to 50%. And then year over year, quarter over quarter, you can keep calculating this ratio and figuring out growth or slowing. You know, you go maybe from 50% to 60%. You can see how efficiently you're operating. And as you add more employees, if you go down that road, you can then divide your pre-tax profit across the number of employees. You can get an efficiency of labor from that number. So it's all about how efficient is your company running. So this number here, you can, again, watch it rate of change from quarter to quarter, year over year, and you may bounce around between 40 and 60%, which means you kind of got this stable, not really growth, but you just got this kind of a plateau going on in your revenue. So that kind of information, and also whether you're growing rate of change or declining rate of change, will come out as well. So it's a great number to use as a comparison. But again, if we go back to the importance of salary, especially in a full-time company, one where this is your main source of income, if salary were left out, pre-tax profit would not be correct. And when you start calculating these ratios and you start figuring out taxes, it's all going to get distorted. It's all going to be inaccurate. So that's why it's so important to begin factoring salary. Now, in our smaller company that wasn't making that much money, year 1 we left salary out, but we then chose to factor it in through sweat equity. So it's back there building up until we begin withdrawing it as we go full time through maybe distributions. So you draw your full salary once you go full time, assuming revenues allow it, and then you can maybe start taking some of the excess out through distributions that was backed up, or just leave it as equity inside of the company. And as you're going part-time, you may find that, okay, I can start taking a small salary. So if the salary is $60,000, you may start taking $30,000 or $20,000 in year 2, because you're still part-time. You can't really comp the full salary. But if you are working with an accountant, and again, you don't have to spend a lot of money or a lot of time with an accountant, maybe that initial 1-hour meeting in year 2, you can ask them about it. You know, let them or tell them, I want to take a salary. Is that advisable? I want to take partial salary, maybe 30 or 40% of what I would normally take, and then the rest of it we can leave as sweat equity. So your salary would come out. You have your pre-tax profits. From your pre-tax profits, you can start seeing the impact on equity. You can start taking distributions to pay your taxes. You have a correct salary. You're paying taxes, of course, and the more taxes you pay, it means the more you're earning. And this kind of goes off into a tangent, but when you're trying to put in a lot of expenses to bring down taxes, you're basically spending $1 to save 40 cents is one way to look at it. You're going to make more if you just pay your taxes and not worry about trying to game the system by ramping up unneeded expenses, for example. So keep that in mind. The more taxes you pay, it means you're growing. You're doing things right. And when you've got this salary that's correct and you take small distributions, you're going to get into less trouble. It's when you skew it the other way, you try to take a lot of distributions and a very, very small salary, and your company is full-time, you're definitely going to draw attention of the IRS. If you keep doing that year over year over year, you're going to find yourself in a bad place. It's going to be difficult to untangle all of that. It's going to be very expensive. It's just not really worth it. So this is just a look at how to factor in salary, its impact on your pre-tax profits, and the importance of recognizing you need to build sweat equity, or if you're full-time, you do need to draw a proper market wage salary. And market wage, you can get that from places like salary.com, maybe from the company you came from as an employee. If you're doing a comparable job, you could probably take a similar salary. You can look at the job boards, what some of the asking is on job boards to figure that out. So again, this is just an additional piece to stress the importance of salary and taking that salary, keep it in mind, and if you're not able to take it, to build sweat equity in it.